Hello, everybody. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. Welcome to the show. It's been a weird day in markets. It's been a weird week in markets. Lots of back and forth, lots of volatility, and quite a lot of divergence amongst the key asset classes that make narrative making and trying to understand what all is going on a little bit difficult. What we're going to do today is we're going to focus on one of these episodes and try to unpack it. It's one of the weirder recent events in markets in terms of the way that they digest incoming information and how they respond, and might just give us a clue about what is probably the biggest piece of event risk coming up, certainly this month, maybe this year. The June FOMC policy announcement next week. So, without further ado, we are going to focus on the situation that happened with the Bank of Canada this week. It appeared as though the markets were responding like this announcement was a preview, tipping off what the Fed might do next week, which of course is a huge question. June being the time when the Fed was arguably expected to have all but wrapped up its rate hike cycle. At the beginning of the year, the Fed's message hasn't changed. The markets have done every which thing since then. We've had a run-up in economic data, then a banking crisis, then the debt ceiling debacle. Now we're back at the other side of both of those things, trying to figure out, with the settling of the dust very much underway, where are we and what comes next? So an immensely consequential policy announcement next week. Oh, and by the way, it will be preceded by official inflation data. So a whole lot of speculation riding on what's going on, and of course, tremendously important speculation, because what we're talking about is the cost of money worldwide. When the Fed alters its policy settings, because it is changing the borrowing cost of the global reserve currency, it is changing borrowing costs everywhere, not just in the US. Changing the hurdle rate on financing anything, consumption, investment, anything at all, worldwide, with the possible exception of a few economies that don't participate in the global commercial system, like, say, North Korea. So to have gotten an early tip-off here would be tremendously consequential. Let's take a look at what happened and why the markets reacted the way they did. Here is what we were looking at before the BOC announcement. Now, I want to stress this again. This is not the current setting of policy expectations. This is where we were the day before the BOC. And you can see here the expectations were for the announcement that we got yesterday, that there was a 44% chance of a hike. So less than even. About 11 basis points out of 25 were baked in. Now, critically, the hike did not come out of the clear blue sky. The hike was in the forecast, just a question of timing. You can see here that between June and July, the hike was there. The probability was over 100%. If you add 61 with the 44 there, that's how you end up with 1.05, 1.06 in the hikes cuts column. That's how it ends up being over 100%. So the markets were convinced that there would be a hike. Look at the implied rate delta there. You see it's 26 basis points, 1 basis point more than the minimum threshold for a full hike to be priced in. It was in the market. The question wasn't whether the BOC would hike. The question was timing. And what the market was in the mood for here ahead of this announcement was that the hike wasn't going to happen this week. that it was likelier to happen mid-July. And clearly, the BOC surprised. Now, they cited economic news flow from April as being the deciding factor. So let's take a look at what they saw. What is it that the BOC ultimately discovered that tipped the balance here? Well, if we look at the way that economic data performed in April here, frankly, it isn't much to look at. Looking at the economic surprise index here, we did see a pop through that 20-day moving average, so perhaps the trend has been altered, but the pace at which data has been outperforming relative to expectations is really nothing that's particularly shocking. It certainly seems to be within recent ranges for the values here. It's by no means a runaway train of strong economic data. Furthermore, housing has been an overwhelmingly important question here because housing is about 30% of Canadian CPI. So if we look at what actually drives inflation in Canada, it would seem that we're actually on a fairly benign path forward here. Consider that housing, of course, tends to move relatively earlier in terms of its response to these kinds of cycles. And so what you see here is something with a whopping 10-month lag. But you clearly see the path toward disinflation here when you consider how much of CPI is housing and what housing is doing. But let's consider sort of the full breadth of this. Housing, based on the latest reckoning, as I say, is about 30% of the overall pie here as far as CPI, 29.8 as of last reading, and that's for 2021, where those weights were last updated by the STCA, Canada's statistics agency. The other big ones: food at about 16%, transportation at about 17%. Transportation, overwhelmingly the maintenance of private and retail level vehicles. And of course, the biggest component there, fuel. So what we're talking about here really is a story about food, shelter, fuel. So unpacking this gives you somewhere on the order of 90%, almost 90% of the entire CPI basket. So looking at that, we see here some divergent influences. On the food side of things, we have actually a bit of an inflationary story here. The Bloomberg Commodities Index for soft commodities, which is essentially a proxy for the price of food here, that's been going up. CPI has been trending lower, as has energy. Energy coming out of the mix here, a very important component for disinflation, not just in Canada, but elsewhere as well. So perhaps here there was a bit of a mixed message. Perhaps what the Bank of Canada was looking at was saying, well, look, these food prices are offsides here. We need to address it. But between housing and energy, most of the story has been about disinflation here. You can see both here and here, that continues apace. There was a blip of an increase in CPI in the latest numbers. You can see that on the chart here. We point out just right there was a slight bit of an uptick in inflation. But really, the story of disinflation continues even as these soft commodity prices have gone up. So is this enough of a reason for the BOC to have done what it did? Well, this seems to be the bottom line. Take a look at the relationship here between Canadian CPI. This is 2 months lagged here. There's that slight little uptick from 4.3 to 4.4% in the latest number, coming down from 8.1% near the middle of last year. And over top of that is Canada's 5-year break-even rate. The break-even rate, the market-based expectation for inflation, that's derived from taking the difference between the nominal and the real bond yield, the inflation-adjusted bond yield. When you take that difference, it gives you the magnitude of that inflation adjustment and gives you the bond market's inflation expectation. So what we are seeing here appears to be a disinflation that started in an orderly way, just as inflation expectations would have anticipated. Those inflation expectations leading by 2 months, something that ultimately ends up showing up right on cue in CPI. But then right around the beginning of this year, there's a change. Notice this flatlining here. Now, of course, it's still flatlining over a 5-year period near the target. So ostensibly, what this is telling us is that over a 5-year horizon, the BOC is seen getting to where it wants to go. It has a target of 2%. Inflation expectations are hovering just about there. But they're not continuing to move in a disinflation direction. And if they've stopped moving, then perhaps this has stopped moving. If this break-even leads realized inflation by 2 months and it has stopped, then perhaps what we're looking at is a similar stop somewhere in the actual inflation numbers, and perhaps that stop over the BOC's actual policy horizon of less than 5 years. The typical way that central banks define quote-unquote medium term is around 2 to 3 years. That's been at least the standard set back in the 90s by, of all central banks, the Reserve Bank of New Zealand. But what we're looking at here then might be, and this borrows, granted in paraphrased form, directly from the BOC's statement, the rising risk that maybe inflation settles above 2% within the window that they need to get it down to that level. And so when we kind of weigh all the influences, the bottom line seems to be this. The bond market stopped buying continuous disinflation. They lost faith in the process continuing and said, well, now we're idling. And it didn't really seem to matter that they were idling at the target. It seemed to be that what the BOC wanted to see was continued movement lower in inflation expectations. And that seemed to tip the balance. Now, we can see the markets were definitely surprised, because if we look at where the yield curve was after the last BOC announcement, we can see it has been shifting more hawkish. The small dashed line is where it was a week ago. But clearly, the BOC announcement shocked investors, because you can see how rapidly that curve moved up, even relative to its more hawkish setting from a week before. So this rapid jump here across the entire curve, there's the rate hike, by the way, from 4.5 to 4.75. That's the actual policy announcement that we saw yesterday. And then the whole curve shifts up. So the market clearly walked away expecting a more hawkish BOC after this and was clearly taken for a ride because it thought that the outcome wasn't going to be what it was. And so there was a lot of volatility. There was a lot of repricing to do. Interestingly, though, that repricing was not confined to Canada. And this is really where we're heading. This is the big question that we grapple with here on Macro Money in today's session. Here's the policy announcement. Notice it happens just around 1400 GMT. You can see the big spike there. It's unmistakable. In the red is the Canadian dollar. That's the 6C future. And of course, when the Bank of Canada delivers a surprise rate hike, it spikes. It has every reason to spike in that kind of a scenario. We talked before about interest rates on currencies being essentially the cost to borrow that currency, and then the flip side of that, of course, being the income to be had from lending that currency. So when interest rates rise for a given currency, it becomes more attractive to be a lender of it because you can extract more income that way. And so owning that currency becomes more lucrative. You then see a move into that currency and the prices rise. That's sort of the textbook response. So it makes sense that a higher rate structure, especially an unexpectedly higher rate structure, that comes to us courtesy of this BOC announcement, as we just looked at here, makes the currency more attractive, the currency spikes. What's more interesting is that at the very same time, you get a jump in U.S. Treasury yields and in the U.S. policy outlook. So the futures implied rate reflected in Fed funds for the end of this year jump in tandem. The 2-year U.S. Treasury yield jumps in tandem. What this seems to suggest is that the market looked at the BOC and said, yeah, okay, this is a Canadian dollar signal. This is a local Canadian asset signal, sure. But this is a Fed signal. This is tipping us off to what the Fed is going to do next week. Now, why would the market conclude that the relatively tiny economy of Canada, which is basically the size of a U.S. state in terms of its population, granted, its GDP places it firmly in the G10. It's a very prosperous nation, but we're talking about seemingly the tail wagging the dog here. But let's consider this is a breakdown of Canada's export destinations. This courtesy of the excellent Atlas of Economic Complexity. It's available from Harvard University online. I suggest you guys check it out. It is an absolutely fascinating tool that generates, as you can see here, really, really cool graphs. And of course, relays a tremendous amount of excellent information. What you can see here is that 73% of Canada's exports go to the U.S. It's not even close relative to other countries. 4.9% for China, 3.9% for the UK, 2.4% for Japan. It's not even remotely in the ballpark. The U.S. absolutely dominates. So the question becomes, if Canada feels that its disinflationary dynamics aren't sufficient, that inflation expectations have stopped falling, why is that ultimately? Well, perhaps because demand is more robust. Why is demand more robust? Well, the only people buying things from Canada are in the United States, seemingly, by a large skew. Obviously, I'm painting with a very broad brush here, but clearly there is a logical line here to say, why is demand in Canada stronger than the central bank expected? Well, perhaps because demand from the United States is stronger than anybody expected. Because clearly, Canada is very leveraged to U.S. demand here. So if that's what's going on, what does it say about what's going on in the U.S.? What does it mean for the Fed? Well, this, of course, sets us up for what is the great big FOMC announcement next week. And what's going on in the U.S. has some interesting parallels. We've looked at this chart before. It shows that the transitory elements of inflation have probably been squeezed out of the system already. We can see the Baltic Dry Index, which is a benchmark for shipping cost, is back down to pre-pandemic levels. We can see that the intermediate and final distribution service costs in the U.S., this is the cost to get goods by wholesalers from either where they are going to go through one stage of production and to the next one before they're finished, that's the intermediate component, or from where they're finished to where they're ultimately sold, that's the final component. But we can see both of those have absolutely cratered. The year-on-year growth rates here back to pandemic era levels, never mind before. And of course, shipping costs were very low during the initial onset of the pandemic because, of course, everything was locked down. So what we're looking at here is seemingly not a story of we're going to fix supply chains, we're going to improve efficiency, and that'll get inflation down. No, it seems like we're going to have to hurt demand. It's not a supply side issue at this point, it would seem. Now it's a demand side issue. Looking at the way that U.S. economic data has been performing, disappointing jobless claims earlier today and disappointing ISM earlier in the week, notwithstanding, the trend has been toward improving economic data. Consider that, as with Canada leading into its policy announcement, the economic surprise index for the U.S. has broken its 20-day moving average. By the way, why a 20-day moving average? Because there's about 20 days, 20 working days in a month. So really what we're saying is, what is the 1 month trend, and is the actual daily data breaking where it's trending on a 1 month basis, just to give ourselves a bit of a benchmark. Recall what happened the last time we broke out here back in February, and the surge that followed in yields, in the dollar, the negative response from risk, which of course all ran us up directly into the SVB crisis, or the SVB-led crisis, at the beginning of March. But the makings here look very similar to what we saw in Canada, a preliminary poking through the average here, suggesting that maybe U.S. economic data is back on the incline. We see something similar in what is the demand side source of inflation at its most significant. So if we've squeezed out what we did already on the transitory side of things, this is the part that's sticky, and this is the part that the Fed is most interested in breaking. Consider we still have a significant labor supply versus demand imbalance in the wake of the pandemic. So you can see here, during the pandemic, there was a lot more labor supply than demand. So those blue bars that you see there, very high. As you start to get reopening, that supply-demand imbalance comes off. More people obviously come to work, more businesses are reopened, lockdowns are eased, and so the imbalance washes away until you get to about the beginning of 2021, where you can see, and I was arguing this at the time as the Fed was gearing up for its rate hike cycle that it ultimately had to admit that it was going to do in the middle of the year, that the problem was starting to become sticky because of wages. Because what was happening was an imbalance in labor supply and demand gone the other way. Now there was a lot more labor demand than supply. And so you started to have this inflationary imbalance because, of course, if there is less labor than is demanded, and the way that we've figured out labor demand here, or at least a benchmark for it, is we took the labor force, so the number of people that are employed or want to be employed is labor supply, and then the number of people that are employed plus job openings, so the number of people that businesses want to be employed, that together, so people working and people that businesses want to be working, that's labor demand. So looking at this here, we can see it has been improving and then has stopped improving most recently. We got that JOLTS job openings data last week that pointedly gave us this right here. Notice that is the first time in 4 months that this has gone the wrong way. The imbalance had been narrowing, and in May, it pointedly stopped narrowing. And so what we're looking at then is a situation where maybe the Fed feels compelled to act more forcefully. Maybe there is a parallel here with Canada and perhaps some inspiration from what's going on in the US in what Canada ultimately was doing. Here's a very similar chart to what we were just looking at for Canada for the US. The yellow bar is here, the 2-year break even. Now, you can see here that on the one hand, it's at 2.1%. So what the market is basically saying here is that the Fed over the course of the next 2 years will bring inflation down from 4.4% PCE or 4.9% CPI, which you can see there, to a rate of 2.1%. So they will be successful in getting essentially on target, pretty much, within the period allotted, within this 2-year window. But what you also see, in a nod to Canada, is that clear-cut disinflation seems to be flatlining as it did there. So take a look here, and what you see, clear-cut disinflation here. You can see it, as with Canada, it leads realized numbers by about 2 months. And then here you have something of a flatlining. Bit more of a messy one than what we saw in Canada. But again, we seem to be moving sideways, much like what we saw when we looked at the situation in Canada here. Disinflation, and then we start moving sideways. A bit choppy, but nevertheless. If that is going to be a precursor to what this means for the Fed, then maybe there really is a lead here, or at least maybe the markets are reasonable in looking at what happened in Canada as potentially a catalyst. We can see here that with the unraveling of this debt ceiling debacle, markets spent most of May doing that, even as policymakers and the journalists that cover them were still running around making breathless headlines about it. The markets at the start of May had already convinced themselves that this was not going to be a big thing. And so we can see rate cut expectations were already coming off the board. There is the expected policy curve for June's FOMC announcement. That's next week. Then the December one. And so essentially what this gives you is what policy expectations were going to be at the middle of the year and the end of the year. And then the gray bars are the difference between those two. And you can see that over the course of May, we went from pricing in about 100 to 75 basis points in cuts in the back half of this year to now essentially pricing in none. So clearly the market is responding. Now, it isn't responding necessarily to take away anything the Fed has surmised. It's more so taking away its own speculation on rate cuts that the Fed said it wasn't going to do all along. But nevertheless, there's been a pointed hawkish shift in the outlook. And as we've just outlined, some of the atmospherics here are very Canada reminiscent. Take a look then at what the policy expectations are. The Fed seen with a probability of about 30% raising rates next week. We can see it's much more of a potent likelihood at the July meeting, about 48% chance of a rise there, for a cumulative 77% chance of a hike sometime between June and July. We can see 19 basis points out of 25 are all the way priced in by July. We can see it starts to deteriorate again in September. So it looks like there's about a hold implication there. So 17 basis points priced in. Come November, only 6. Come December, only 7 in the other direction. So it would seem that if rates currently are at 5%, which of course they are, and if by December they are back to 5%, what the market seems to be saying is that we have a close to 80% chance of a rate hike sometime in June, July. We have a cut that's likely sometime in November, December to take that away. We can see that between the June and the September meeting, we're looking at 24 basis points baked in for July 26. So the hike is ostensibly already here, and then it's taken away. So the question, as with Canada, seems to be of timing. Are we going to get the hike sooner, or are we going to get the hike later? And if we follow what the Bank of Canada seems to imply here, the surprise factor, given some of these parallel similarities, could be that it comes next week and not in July. Now, of course, the possibilities are still not just less than even, but significantly lower than they are that, in fact, it's in July. But of course, that's exactly the way that the Bank of Canada was setting up. It was a little bit of a higher chance by about 10% in Canada. We can see that it was closer to 45% chance that we'd get a hike, about a 40-60 split, and the Bank of Canada decided to surprise. In the case of the Fed, it's more of a 70-30 split, but nevertheless, we could be looking at a bit of a tip-off. At least the markets seem to have reacted that way. And that is macro money for today. This is our last show for the week. We will, of course, be back next week. We're here Monday through Thursday every week after Overtime, which is a show that I do with my colleague Chris Vecchio, head of Futures and Forex here at tastylive, where we break down that day's events in markets and try to make sense of them. I'm back on with Chris on Fridays for Futures Power Hour. That's where I'll be tomorrow, so come check that out. And I'm also on with Tom and Tony for First Call on Sundays as Asia markets come online for the week. I'll, of course, be there this coming Sunday as well. Outside of those shows, I'm opining on Twitter at Elias Pback. Thanks very much for joining. Good luck out there. Take care.